In this video I will solve a question for ratios in which we are supposed to calculate return on equity. Now return on equity is profit after tax divided by shareholders equity. And as discussed in class, if you are provided with opening and closing balance sheets, return on equity will be profit after tax divided by opening shareholders equity plus closing shareholders equity divided by 2. So let us solve the question directly. I have discussed the return on equity formula in another video. In this video I will solve question number 10, and it says that the home company is attempting to establish a current assets policy. There is a company named Home Company, and it is setting up a current assets policy. Now this is a general term, it is not something specific. Current assets policy is this company's policy which it is designing. It says that fixed assets are 1.2 million. So we know that the value of fixed assets will be 1.2 million, and that is fixed. And the firm plans to maintain a 60% debt to assets ratio. 60% debt to assets ratio means that debt divided by assets into 100% is equals to 60%. Or simply, my debts will be equal to 60% of my assets. Or we can also say that if I have 100 rupees of assets, I will have 60 rupees of debts on my balance sheet. Okay. After this, the question further says that the company has no current liabilities. So the value of current liabilities will be 0. The interest rate is 10% on all debts. We have to pay interest, which is 10%. 3 alternative current asset policies. Alternative means different. I am not adopting a single policy, but I have 3 options, I have 3 alternatives, I have to select one of them. And what are these policies? 30, 50 and 70% of projected sales. So my first policy is that I will maintain my current assets at 30% of my sales. Whether I should do that or not, that is what I have to decide. Or I can maintain my current assets at 50% of my sales value, or I can maintain my current assets at 70% of my sales value. I have to select either this or this or this, and I am not decided about it. It further says that the company expects to earn 15% before interest and tax. 15% before interest and tax means profit before interest and tax. Profit before interest and tax is the amount from which we expense out our interest amount, and after that we subtract our tax amount and we obtain the profit after tax amount. This profit after tax amount is to be used in our ratio over here. So it says that the profit before interest and tax, or earnings before interest and tax, is 15% of the sales, and sales is 6 million. Tax rate is 35%, sorry. What is the expected return on equity? I have to tell the return on equity under each alternative. There are 3 alternatives, so I have to calculate return on equity for each of them. Let us solve it for the first alternative. The first alternative that a company has is to maintain its current assets at 30% of its sales. Let us solve the question for the first alternative. Now if I have to calculate the return on equity, I need 2 things. I need profit after tax value and I need shareholders equity. Profit after tax can be obtained from profit and loss account, and shareholders equity can be obtained from balance sheet. So I will need to prepare both. I will need to prepare P&L and balance sheet, and then I can calculate return on equity. Let us now calculate the return on equity value and see all its workings. Let me solve it for the first alternative. Alternative number A is to maintain my current assets at 30%. So let us first make the balance sheet. Balance sheet will have assets. There are 2 types of assets, fixed and current assets. And it will have liabilities and equity. There are 2 types of liabilities, current liability, long-term liability, and yes, the last one is capital or shareholders equity. The first line of question says that fixed assets are 1.2 million, so I know that this amount will be 1.2 million. After that, if I am making my balance sheet for first policy, it said that you will maintain your current assets at 30% of your sales. So your current assets will be 30% of what? Of 6 million. Why 6 million? Because 6 million is my sales. So 30% of 6 million is 1800,000, and therefore my total assets will be 1.8 and 1.2 million is 3 million. The question further says that the company has no current liabilities, so current liabilities are 0. Here it is. The company has no current liabilities. So since company has no current liabilities is 0. Long-term liabilities or debts. It said that the firm plans to maintain a 60% debt to assets ratio, means if my assets are 100, my debts will be 60. Or simply, if my assets are 3 million, if my total assets are 3 million, here it is, so my debt will be 60% of 3 million, and 60% of 3 million is 1800,000. Now I know that the footings must match at 3 million. Since it is a balance sheet, total of assets must be equal to total of liabilities and capital. So this amount will be my balancing figure, and it will be 1.2 million. Now I have to make profit and loss account. From profit and loss account, I can obtain the profit after tax value. Okay, let's see my profit before interest and tax. My profit before interest and tax amount is 15% of my sales. My sales are 6 million, and if my sales are 6 million, 15% of 6 million will be my profit before interest and tax, and it will be 900,000. After that, I will subtract interest expense. Now the question says that my interest rate is 10% on all debts. So this is my all debts. These are my debts value, which is 1.8 million. So my interest expense will be 1.8 million 1800,000 multiplied by 10%, which makes it 180,000. And if it is 180,000, so my profit before tax amount will be 720,000. Further, I have tax expense, and to subtract tax, the question says tax rate is 35%. So if tax rate is 35%, my tax amount will be 720,000 multiplied by 35%. 720,000 into 35% is 252,000. So my profit after tax value, PAT or PAT, will be 720 minus 252 is 468,000. And therefore, under 30% alternative, my return on equity, which is equivalent to profit after tax divided by shareholders' equity, will be profit after tax is 468,000 divided by shareholders' equity. My shareholders' equity from my balance sheet is this much, which is 1.2 million. So 468,000 divided by 1.2 million into 100%. This will make it 39%. So this is my final answer under 30% alternative. Now if you solve it under 50% alternative, which I am not solving in this video, your answer will be 25%. And if you solve it under 70% alternative, your answer will be 17.33%. The worked out examples of both of these alternatives and as well as 30% alternatives are in a picture form at the Facebook group Accountancy Guides. You can download the solution from Accountancy Guides Facebook group, where I have solved the 50, 70 and 30% all three options. Thank you for watching this video. I will upload more ratio question and answer videos to help you in your FAR1 paper.